Welcome to Opto Sessions, where we interview the brightest minds from the stock market, uncovering their secrets to success. If you're looking for ideas, tips and techniques from the world's best, you're in the right place.
I'm Hayden Brain, and welcome back for another episode of Opto Sessions. 5 years on from a now legendary short, Valeant Pharmaceuticals, a bet that brought a $90 billion company to its knees, and which has since been documented in the critically acclaimed Netflix series Dirty Money, I'm catching up with Fahmi Quadir, the 29-year-old short seller shaking up Wall Street. 2020 brings with it a new foe, Wirecard, a German payments company currently embroiled in a market manipulation probe, and one that's been firmly in Quadir's crosshairs since the start of 2018. I ask how Fahmi identifies these high-conviction bets, how she battles discrimination in an industry marred by inequality, and which fraudulent, unethical business is next on her hit list. Hello to everyone listening. Today we're lucky to be joined by Fahmi Quadir, founder of Safkhet Capital Management. Safkhet is a short-only hedge fund focused on fraud identification and deep forensic research. Fahmi previously worked as an equity analyst for Kren Savage Asset Management, where she played a pivotal role in successfully shorting Valeant Pharmaceuticals, having previously worked for Dealers Consulting as an analyst and senior associate. Fahmi was named in Forbes 30 Under 30 list in 2018. So hello and welcome, Fahmi. Great to have you on the podcast.
Thanks for having me.
Great. So I wanted to start by asking a few questions about Valeant. We'll then get into your background more deeply, but I'm conscious that a lot of our listeners will be familiar with the Valeant Pharmaceuticals short and the campaign surrounding it. So first off, Valeant Pharmaceuticals, as far as I'm aware, commanded a colossus equity market value of around 90 billion in 2013, so just 5 years ago. But then in 6 short months, the firm had lost around 90% of its value, and it was only maybe 6 or 7 people in the world that actually spotted that downfall, and of course you were one of them. I mean, what did you spot that so many others, including billionaire hedge fund manager Bill Ackman, what did you spot that so many others missed?
Well, it's funny that you ask about this. Just the other day, I was thinking that it's almost 5 years to the day that I initiated my short on Valeant Pharmaceuticals. And it's incredible to think how much has changed and how much my life has changed in that time. I'm not sure if it's fair to say that only a handful of people recognize the issues at Valeant. I think there were definitely a group of smart investors who were talking about how Valeant was engaged in financial engineering and earnings smoothing, and how it was essentially this house of cards. I think that narrative was there for a while, but the issue was with Valeant is that you had a successful, sophisticated group of institutional investors who were long and successfully long Valeant for a very long time. Individuals who otherwise would not get involved in investing in going long fraudulent companies. So I think that disconnect perhaps scared others or deterred them from going short. But I came to this story as a complete outsider. So I didn't really understand or care for the dynamics then or now. I don't really think about Bill Ackman. For me, it was more about understanding the business model and the sustainability of that. It's one thing to understand that something is wrong and that there may be, smoke and mirrors involved, but it's another to actually go short. And I think because of the dynamics at play here, people were definitely afraid to go short. The stratospheric rise that the stock had over the years preceding 2015 also definitely deterred people. So even as the short thesis started to materialize on Valeant, I think people were apprehensive of staying short. So I believe throughout that whole, 1-2 year period, my firm was short. Maybe as a small fund, we were short, at some points over 10% of the short interest. So while it was lonely actually shorting, I think there was definitely a lot of skepticism. But for me, it came down to understanding how long can the game go on? And the thing about the pharmaceutical industry is that it is very established. There are a certain set of norms, there's a certain set of regulations, and a certain set of behaviors that lead to success. And when a business comes in and starts to actually throw some of these norms to the wind, then it's a cause for concern. So it really was as simple as understanding that, yes, Valeant was an acquisitive roll-up and it benefited from a tax inversion scheme. At the end of the day, because it was raising the prices on all of these drugs to a level that they were completely unaffordable, to the point where insurance companies were starting to slow down the reimbursement of the drugs. What that means is that you won't have patients to actually take those drugs. So ultimately, this can't keep going, especially if you're unable to continue with inorganic growth, which would mean acquiring more businesses. So when I came to the story 5 years ago, they had completed their acquisition of Salix Pharmaceuticals, and they were sitting on a pile of debt. And that's really when things started to unwind. And where they were with their product portfolio, the sales had really peaked. So the unwind seemed clear to me when I came in.
Yeah, sure. And just to pick up on your point about the hiking of prices of some of these drugs, I mean, I was doing some research before the call, and a lead poisoning remedy was actually hiked by, I believe, 2,700%. I mean, these are drugs that obviously safeguard the health of people all around the world. I mean, how did it feel to be sort of the vanguard of the effort to put a stop to such immoral practices?
You know, I never really think about it that way, because ultimately I'm in the business of making money, and we are trying to expose these practices. But what hurts is when these practices are exposed, what happens next? And while in 2015, the latter half, there was a really meaningful and diligent discussion around drug pricing, what happened? Absolutely nothing. There's a certain amount of ADHD in the way we discuss problems, especially in the US, that we quickly jump from one thing to another. Meanwhile, patients and their families that are affected by these price hikes are continuing to fight. So if anything, my heart just breaks every day. The fact that the facts are out there, and that we all sort of agree, we're on the same page that this is a predatory practice, but we refuse to do anything about it.
Yeah, completely. I think that's completely fair. I mean, we will return to Valeant later on in the episode, and hopefully that's worked to whet the appetite of some of our listeners. I wanted to actually take a step back and sort of talk about your background. I mean, it's potentially fair to say that you weren't always dreaming of becoming a hedge fund manager. Perhaps the job found you to a certain extent. What's your take on that?
Yeah, it's not only fair to say, I explicitly never wanted to be on Wall Street. I was always a fierce critic. My whole life, I've spoken out on issues of inequity, specifically systemic issues, and a part of the establishment is, of course, Wall Street. So I was never interested. It really was a serendipitous event for me to become a short seller and then go on to launch my own firm. It was just the fact that I left myself open to the experience. And some might say that these are all things that sort of happened by accident, just meeting certain people and sort of finding the right place for myself. All of that, in some ways, happened by accident, and I don't even know if any of it would be replicable in another life. So in that sense, I'm incredibly lucky that it all happened. But no, I never expected to be in this position, and at the same time, if I was doing anything differently than I am today, I certainly would not be in this industry.
Yeah, sure. I mean, that's interesting. And I guess it's one move to start working on Wall Street, but then it's a further sort of specialism, I suppose, to actually start short selling, one that many avoid. I mean, what excited you about that side of the market?
Well, I would say I don't think even to this day I'm a part of Wall Street. I started out as a short seller, and to this day I'm still a short seller. So that was my lane, and I've strictly stuck in that lane. But as far as what excites me about it, it's certainly challenging relative to other things you can do as far as trading strategies. But really, it's about the search for knowledge, the search for facts, being able to piece information together. And also, part of the pleasure is being a contrarian in the market. I know a lot of people say it and it gets old, but for me, it's not just about being a contrarian in my industry. I think generally I always like to think about the other side. And I've always been in a position where I tend to argue my point, and I will take very firm positions on certain matters. So short selling just sort of fit into my worldview and my value system. So that's why it was so perfect. And at this point, it's hard to imagine doing anything else.
Yeah, sure. I mean, perhaps it might be interesting then to talk about what makes a good short seller in your opinion. I mean, from the kind of short conversation we've had already so far, it seems an investigative sort of streak seems key. But what, in your opinion, makes a good short seller?
Well, I think it starts out with being a really good listener. I usually say that you have to be good at asking questions, but to be good at asking questions, you need to be good at listening. So you'll find that a lot of short sellers that are really good at what they do, they tend to talk less because at every point they're making observations, and they don't want to insert themselves and sort of artificially create a different outcome. I really see myself as an observer, and that really allows me to better understand the world around me and the companies that I'm investigating. So that's certainly part of it, but you also have to have a really high pain threshold. A lot of folks like to say that there's ice in her veins, or short sellers are so cold-blooded, which I think is an unfair characterization. I think it just means that to be good at short selling, especially in the way that we do it, you need to be able to stay grounded in the face of intense pain in the markets. You need to be able to objectively and without panic make decisions based on the facts. And that usually means that in some cases we are tolerating more pain than the average market participant.
Yeah, sure. And you kind of referenced a few of the more negative connotations that come with the job. I mean, I wonder whether those bother you at all? I mean, is that something that troubles you on a day-to-day basis?
If I sat around and thought about what others think of me, then I really don't think I'd get much done. Yeah, I do this because I love what I do. I am motivated by exposing the fraud. It is what I've always loved. I feel like this fits into my world, and whether people believe that or not, I could care less. The thing that is, I think a lot of people who don't know me may think that this is a gimmick, this whole idea that I am trying to find fraud and it has to be about more than money. But that's fair, because I think some may actually use it as a gimmick. But if you look at everything I've ever done in my life, it's always been guided by the same principles. And that is true today as well. And in reality, short selling exclusively. So we short sell, and we do it in an unhedged way, in a concentrated way. I could do other things that would allow me to make more money easily, and allow me to raise more money. I could run a long short fund. That would reduce a lot of the headache and the so-called pain of the markets. But I don't because that's not what I want to do. So I'm really just focused on what I love and what I'm good at, and whatever others may say about it, that's their problem.
Yeah, completely. Okay, well, I mean, I think that does a good job of sort of covering your convictions and sort of your underlying philosophy to the markets. And we'll return to some of those points later. I just wondered, and particularly, I think this would be particularly interesting for obviously people outside of the industry who won't get a glimpse into what it's like for working for a hedge fund, let alone running one. I mean, what does your day to day look like? I mean, I imagine it varies a lot throughout the course of the week.
While there is certainly a lot of variety, I would say that I make a point to have as much routine in my day as possible. Apart from the research component, I'm now a fiduciary. I'm a portfolio manager. I have to make investment decisions on a daily basis. So part of my job and part of being able to do my job well is to ensure I minimize headaches as much as possible. And for me, what that means is having as much stability and routine in my life. And to some that might look boring. The fact that every day, I wake up at the same time, I have my morning routine of walking my dog, going to the gym, making breakfast, and that no matter where I am in the world, I try to stick to those things, because you really need to create spaces for yourself, time for yourself to process everything that's going on, process the information that's coming in, so you can make decisions without fear of making them in a sort of rash way. So I think part of my life is boring, but a lot of it is also talking to others, specifically my partner, my analyst, Christina. It's always a back and forth discussion, if not a debate, about various things that are happening throughout the day, which happens a lot more now that we're stuck at home. So we really just have each other. But a lot of what I do outside of that is travel. And part of that means, talking to strange men in strange places, right? So that part is I guess, the more interesting thing to others looking in. But I would say 90% of it is trying to create as much stability and have really grounded roots as much as possible.
I guess we've discussed sort of your perception in the industry and how obviously the negative side of that doesn't bother you. But I mean, just as a wider point, we see few women running hedge funds to the industry's detriment. I wanted to get your take on kind of what it's like being a young woman. I mean, you started your hedge fund in your 20s, I believe. What it's like to be a young woman at the top of your profession in the hedge fund world.
Well, I don't know if my experience is necessarily dissimilar to other women who are struggling to move up institutional barriers and obtain the success that they deserve. I think generally, compared to other women within finance, I am incredibly privileged, because I sort of skipped over a lot of the really nasty parts, because I had a short career before I started working for myself. So I avoided a lot of what you might have to deal with at the big banks. And a lot of those cultural problems are things I could just say no. So because I avoided the institutional aspect of finance, I think the part of me that is sort of take no prisoners and will say no and will not bow down to anyone, that very stubborn part of me never got sort of blacked out by the establishment. So I was fortunate enough to keep that part of myself.
Yeah.
And that allows me now in this position to think more about how can we make this industry more equitable for everyone.
Yeah, completely. And I wonder whether you felt sort of any pressure in terms of being a role model or a trailblazer even for other women in the same industry or finance more generally?
I don't think it's pressure. I think it's gratitude, not only as a woman, but as a person of color, to be in this position. All of the gifts that I've been given and the sacrifices people made for me to be in the seat that I'm in. I'm gracious. I love the fact that I can be a role model. If anything, if I can make some small change in this industry, and just because, again, going back to this idea that short sellers have, this ridiculous pain tolerance, I can deal with some of the negative perceptions that are thrown towards women, and I can fight through them because, that's just who I am. So in some ways, I'm glad that I'm in the seat and that I can sort of take some of that heat, and hopefully that'll make it easier for women as they come up.
Yeah, sure. I mean, that makes complete sense. I wonder then, before we move on to Safkhet and your strategy, I wonder whether you could talk to us about, being a business owner yourself, what specifically kind of you're doing within your own business to try and redress this balance.
Well, my first hire was of Christina, who is a woman. So Safkhet is a short-only, woman-only fund, and I don't think anyone in history has had the honor of that claim. In reality, we need to stop with the platitudes, and we really need to start making concrete decisions and going out of our way to bring in diverse voices. And that includes women and people of color. I think we need to stop with this is such a merit-based industry. In reality, there are institutional systemic barriers that prevent women and people of color from actually even getting their application in. So we really need to start diversifying the way we think about hiring into the investment industry, looking for outsiders. Because honestly, outsiders offer a diversity and perspective that makes us better investment managers. I think part of the problem with why the industry has become so stale is that precisely.
Yeah, I completely agree. And hopefully it doesn't sound too trivial, but I want to move us on to the hedge fund strategy, and just sort of keen to focus on your investment technique here, the actual mechanics of running the fund in terms of asset allocation and entering and exiting a trade. What do you think you're doing that differentiates yourselves from peers in the industry, and maybe short sellers in the industry specifically?
Well, we are running a truly short-only fund. So that means we only go short, and we are also not hedging against the market. At the end of the day, we are targeting absolute returns. So we're not just trying to lose less than the market, but we're trying to actually make real money. The main thing that we do differently is that we take very concentrated positions. I think within the short selling world, you have two camps. You have one camp that believes in having a very diverse portfolio of maybe hundreds of names with small exposure to each name. But for us, we take very large bets, very concentrated bets, and consequently, we have fewer securities in the portfolio at any given time. So the reason for this, the thinking is that the amount of time, effort, resources, money that we are putting towards getting these shorts right, it really makes sense for them, for the position size, for our exposure to correlate to the amount of work we've done. That only makes sense because we really want to make money when we're able to hit it out of the park with our thesis. So that part is key. But from a portfolio management perspective, having fewer names in the portfolio allows me to better manage each individual position and make decisions as new data comes in. So I ultimately am able to be a lot more flexible and active in moving things around and responding to particular catalysts or preparing for catalysts. So that's critical. And if I had 100 positions in the book, it would be it would dilute our intellectual capital, and also it would be more difficult for me to manage as a PM. The other thing we don't do is we don't release activists, research reports. We aren't activists. If anything, we're passive activists. With the information we collect, it's right. We're looking for sustainable price declines. We want to be right for the right reasons. And that means we're really trying to understand, what is the point at which the fundamentals can no longer support the fraud, and really getting the timing right and ensuring that the information that we are able to gather is disseminated to the market in a sustainable and appropriate way. So we avoid actually sharing our research, and have found that that's really the way to do it, at least for us.
Yeah, sure. And I wondered whether I could get your thoughts about sort of how you actually establish your conviction on a particular stock. I mean, you must hold suspicions about certain companies that you're working and you're progressing towards confirming your conviction. I mean, how do you actually confirm the beliefs that you have about a stock?
So I think sometimes we like to expect short sellers to have that little piece of information that will ultimately put some executives in prison, and it's never that simple. In reality, that piece of information will be completely inaccessible to us because we don't have subpoena power. We aren't prosecutors. But that being said, we need to think like prosecutors, and we need to think about what pieces of information do we need to confirm our suspicions. So how do we get around the fact that we have to do our research in the public domain? And really that comes down to doing as much work as possible and as creatively as possible. We like to look at everything on the fundamental side and the financials, but we like to really dig deeper and really try to place the company and its behaviors, its actions within the ecosystem it operates. So that means really understanding, how is this company behaving, treating its customers? How do those customers interact with this business? How do peers within the industry interact with this company? And really getting the narrative down. It's about understanding the company very holistically, almost as though we can get into the mind of the people running the company, so we can get a better sense of how they make decisions, how they react to various stressors. And you would be surprised with how much information is actually out there. Increasingly, we've become a far more global society, and most of the companies, given the size of the company we go after, they have these multi-jurisdictional structures. So we can go to, so while Delaware, USA may have the least corporate transparency in the world, we can go to other jurisdictions where we can pull private company financials, and we can start to piece that together with the broader narrative that the company is selling to the street. So it's really about collecting as much information as possible. We're definitely information junkies, and then using that to put together the pieces of the puzzle and really understand what is going on at every level within a business.
Yeah, sure. And I've heard you talk about fraudulent business archetypes in previous interviews, and sort of a framework that you use to kickstart this process of actually identifying a stock that you might then potentially go on to short. I mean, can you talk to us about the consistent traits among these businesses?
Yeah, obviously all of the companies we short will have issues as far as financial misrepresentation and accounting shenanigans. And all of them will also usually have very poor corporate governance. So I believe generally, at least with the fraud we are looking for, it is perpetrated from the top. So understanding the dynamic of the executive team and the management and the board, and how that trickles down to the rest of the organization is really critical. And what we find is that at most of the companies we short, there is a culture of fraud, or there's a culture of exploiting vulnerable populations. We do a lot of work in areas, for example, where the businesses target truly vulnerable populations, whether that's the elderly, in the US, individuals who don't speak English as a first language, or who may not have legal citizenship in the country. These are things, when you read between the lines of how these companies say they are targeting these businesses, when you try to understand why they're doing it, they do it because they know they can take advantage. So that's another theme that we found among the businesses that we like to short.
Yeah, sure. And I guess we've talked about your process in identifying stocks and the positive side of shorting some of these fraudulent businesses. But I guess maybe it would be fair to say that there are often sort of catastrophic results if you get it wrong. I mean, if you are overexposed in a short position, then that could lead to catastrophic losses. I mean, how do you go about mitigating risk? Can you talk to us about your process there?
Yeah, absolutely. I'll first talk about from like a portfolio construction point of view. At every given point in time, I realize that we need to have what I call the boring shorts. And boring shorts are companies, businesses that may be approaching the end of their life cycle, and consequently are turning to fraud to mask the fundamental deterioration. And a lot of times these businesses are out of favor with all sorts of investors, and they're just sort of off the radar. But with enough data and understanding of those businesses and analyzing them thoroughly, we realize there isn't much upside in the business. And though we may not have a strict catalyst as far as, let's say executives being indicted, we do know that the trends in the fundamentals are going in one way, and they've been going that way for a very consistent period of time. So the core of the portfolio, we like to have those types of businesses. And sometimes these businesses may have turned to fraud because of their difficulties, but in other cases, they may have been using fraud or other forms of misrepresentation to keep things going for longer than they should have. And the fact that the fundamentals are deteriorating means the fraud will become more apparent. And generally, what we find with these types of businesses is there are a whole lot of reasons we feel comfortable with being short. And so there's the aspect of fundamental deterioration, but it's also likely that they were doing other forms of fraud. For example, we recently had come across a company that was engaged in channel stuffing. And this wasn't just our assumption. It was clear, and it came out in a legal case that they were engaged in channel stuffing. And then as we dug deeper, that one cockroach led us to many more. And the executives at the company were engaged in price fixing. They were engaged in the use of illegal immigrants and treating them improperly and basically busing them from the border to work for them. There are these various things that come together because when it's very easy to sniff out a bad company. They all there's always that stench that surrounds them, and it's never one thing. So we have that core sort of stable group of companies where we don't think we can lose much money over time, but there's perhaps a more uncertainty around when we'll make large profits on that. But we manage that by keeping those positions relatively small. And then when we have ultra high conviction names, let's say like a 25% position, we won't always necessarily have a position that large, but when a position that gets that large, we have confidence that there is likely criminal activity occurring and that it will result in indictments of executives at that company. And that will require thousands of hours of due diligence. And that would depend, I guess, on how complicated the business is. But it really understanding what's going on, what is the timetable, and really being able to manage the uncertainties as much as possible, so that on a day-to-day basis we can make an assessment of what our exposure should be to that company, and where we are also confident that certain events, like a takeover, for example, are not even possible given what's actually going on at the company.
Yeah, sure. And I mean, that makes complete sense. I wondered then, you've made the decision to enter a position. How are you deciding when to exit that position and sort of when to take your profit? Can you talk us through your process in coming to that conclusion?
So when I started Safkhet, I would tell investors that we look to exit positions within a year. But in practice, what happens is we exit positions a lot sooner. Because when you're running a concentrated book and a regular basis, not only are we updating our understanding of the companies in our book, but also in our pipeline. And we're also always actively looking to add new ideas to our pipeline. Because of all of those moving pieces, for me, it makes sense to actively turn over the portfolio dependent on what is our understanding of these businesses in this point of time. So compared to day one back in January 2018 to now, I realized it makes sense for us to be much more flexible about taking profits when it makes sense, and exiting positions and then re-entering them when the opportunities present themselves. Because sometimes fraud and companies collapsing happens in a straight line, or it happens very quickly. But other times, actually most of the time, it's more of a step function. So we try to understand, what are the variables that will dictate, the next leg down, and we try to trade around that. And I really try to ensure that whatever is in the book are the best ideas that we have that day. So it's really staying on top of the information flow that allows us to do that.
Yeah, sure. And I wondered then, just in terms of how across and on top of the wider market movements you are. I mean, if the wider market is trending upwards, a lot of bad stocks can be dragged up with it. And so I wondered how concerned you are with the general market's up and downs.
Well, this is where the pain tolerance comes in. We're always up against an up market, at least since we launched the fund. So I want to say we're used to it, but it's never nice. It's never nice being in this market where everything is always going up, even in the face of fundamental negative news. So that's frustrating, but we can't let it get to us. So really, it comes down to managing our overall exposure to the market on a day-to-day basis as best as I can. And that doesn't mean we sort of just systematically rebalance the portfolio. It's about being strategic, about trimming exposures where we don't expect there to be hard catalysts in the near term, and holding steady and withstanding the volatility in positions where we do have that kind of conviction.
Yeah, sure. And I imagine, you've had incredible success with the fund, but occasionally that market that has been essentially sort of moving upwards for years now will have caught out a lot of managers. I wonder whether you could talk to us about a position that has gone wrong as a result of that, or just a particular one that sticks out in your mind?
Yeah, so one I really like to talk about, because this one goes both ways, and it was one of the earliest learnings I had in my career as a portfolio manager, and that's Wirecard. In our first year of Safkhet, Wirecard was one of our biggest losers in the portfolio. And the reason for this was, while Wirecard was not as big of a position in January 2018 as it is today, it was still sizable. It was an average size position for our book, around 10%. And this was because we had done the work and we had conviction, but it wasn't larger than 10% because we still didn't have too much certainty around timing there. So what happened was that shortly after we initiated this position on Wirecard, the German DAX announced that Wirecard would be replacing Commerzbank on the DAX 30. And since that point in time, there was just enormous amounts of passive flows into Wirecard ahead of it being put onto the DAX. So the stock essentially doubled. And I was stuck in this position then of having to cover and trim the position as it grew. So I underestimated the ability for the market to move against me there. But this wasn't just a normal market move. Had I known, hindsight 2020, it's when there is a known factor, like in index inclusion, that you're up against, that will almost certainly move the price up no matter what, then it's best to just step away. Because sometimes the market will give a company, indefinite runway. And when that happens, it's sort of a very deadly situation for a short seller. So you really need to know when it's almost certain you will lose money, you should move out of the way and get back in when it's time, when the train has passed.
Yeah, completely. Your kind of interaction with Wirecard has been heavily covered in the media. I wonder, was there a smoking gun, a particular piece of information that confirmed your suspicions about Wirecard?
Yes, we believe we do have pieces of information, as much as you'd like me to talk about it, I won't talk about it. But yes, we did get to the point of our work where there's that aha moment where we had all of these pieces of information and we sort of knew how they fit together. But then we hit something and it was just like, wow, this all makes sense. And it's a lot simpler than we had previously thought. So that was the moment at which we went very deep and very, very heavily short. But thinking about this more generally, because we focus on businesses that are potentially committing fraud or maybe engage in some sort of criminal activity, or maybe they may have some sort of predatory business model, we need to be certain that the jurisdictions where these businesses operate have rule of law. There needs to be consequences to the fraud. So for this reason, generally, even though we have businesses that we're short that are all over the world, we like to see that they have some exposure to the US. The US, of course, has its own set of problems on the enforcement side, but to this day remains the strongest regulatory prosecutorial regime in the world. And we like to at least have some exposure here in the U.S. and as Americans as well. It's easier for us to do a lot of deep research if we're able to do it effectively domestically.
Yeah, no, that's really interesting. And again, to sort of keep it hopefully sort of general, Wirecard's financial statements, I mean, they appear, and this probably is a general comment for publicly traded companies as a whole, sort of inordinately complex. I mean, can you talk to us about how you and the team have attempted to make sense of them?
Well, at some point, you have to take a step back and realize that a business is complex by design. And if you can't, in a few words, explain what the business is doing and where it's operating, then that is a huge red flag. So with Wirecard, it really was about taking a step away from their consolidated financial statements and understanding, yes, they appear not to make sense. Yes, this company always seems to meet its earnings targets. what is hiding beneath the surface? How do you read between the lines here? And you'll see that the company has purposely structured itself in a way that a lot of its business is flowing through black box jurisdictions. And that includes Dubai, where there is so little corporate transparency. So, even if you are able to sort of piece together what's going on at the consolidated company level, you don't really know what's going on underneath the surface, not even at all. So that's the point in time where you have to realize you need to supplement your research into the company with other forms of information seeking beyond just the financials. And speaking more generally, if the companies you're looking at are potentially engaged in fraud and you don't believe the executives and what they're saying, in fact, you may even think that they're lying, then what gives you confidence that those financials are even accurate?
Yeah, completely. I guess to stick on Wirecard, and I've just got a couple more questions on them. I mean, they're still, despite the sort of short interest and the negative press around them at the moment. Last time I checked, they were worth 11.1 billion in terms of market cap valuation. I mean, how does a smaller business, as you've discussed, such as Safkhet, how do you go about tackling such a large company?
Well, we're concentrated. That is what it all comes down to. The reason we're able to focus so much on a single business and dive so deep and deploy so much towards it and understanding it is because we're concentrated, and because for that reason we can afford to. So while yes, it's incredibly expensive, and I've taken on risks personally, going to some of these places. And as in recent headlines, as far as Citizen Lab, Reuters, they've been reporting on some of the tactics that is suspected to be attributed to Wirecard. These are all things that when we got into it, we were not expecting. But the informational inefficiency here is such a huge gain for us, because if we can afford to spend the time and we can afford to understand, that means we're already ahead of most of the market. And given the liquidity, that means we don't ever have to worry about how much we're paying on the borrow, or being able to secure enough shares to short. And even as our thesis starts to materialize, we can likely add to that position. So it's very attractive when you find things like this. And for me, I feel like Wirecard will definitely be one of those once in a lifetime opportunities. Every fraud, every company, every short, everything is a little bit different. Valeant was its own beast. And Wirecard is also its own beast, but both will certainly hold a special part in my heart. Yeah,
completely. And on Valeant, I mean, I imagine at the time that felt like a once in a lifetime bet, and now obviously you've moved on to Wirecard. I mean, it seems that you have been able to sort of get involved with two extremely sort of high profile campaigns and short bets in a relatively short career. I just wondered sort of from a personal perspective how that feels.
I didn't ask for it. I think this goes back to what I was saying in the beginning, as far as sometimes things feel like they happen by accident. And it's almost like, I just ended up here. I couldn't imagine a career where I'm short selling and I'm not involved in either of these two. So, you can make of that what you will.
Yeah, sure. So I did want to return to the pharma and biotech industry specifically, just because obviously it's so in focus now with the coronavirus pandemic. Your shorting of Valeant drew a lot of headlines, as we've discussed, but is the US healthcare sector ripe for a similar short in the near future, do you think?
US healthcare sector, I believe, is always ripe for a short. But what I would say is that while I believe a lot of things are great short candidates one day doesn't mean I can realistically or practically short them today. I just like to take a moment, because you specifically mentioned U.S. healthcare. There are so many systemic problems within healthcare, and when we're having this, broader conversation about inequity within the U.S. and globally as well, part of that systemic inequity is healthcare and access to healthcare. We've been involved, for example, in shorting some of the opioid manufacturers over the years. And even the way that the U.S. system has treated the opioid epidemic versus the crack cocaine epidemic, one was treated as a criminal matter and one is treated as a public health matter. So, as we're engaged in shorting, it's also important to be totally conscious of these problems and these disparities. And while it's not, within my purview, actually creating policy or creating change, the hope is that as we're shorting these companies and as these behaviors come to light, that those that do have that power actually do something about it. So healthcare is one of the parts of our establishment here in the U.S. that is one of the greatest sources of inequity and has been for a very long time. And because there are so many regulations involved, and because we're talking about people's lives, it is certainly a great place to start shorting. And I was very fortunate from my seat to have started out by shorting healthcare companies, because I think generally they tend to be more complex because of all these different regulatory hurdles they have. So starting out with that expertise is a benefit. Because I think a lot of short sellers over their career will try to develop that expertise, whereas I was fortunate enough to start out with it.
Yeah, completely. I mean, I certainly agree that sort of the fundamental makeup of the sector, it seems a fertile environment for the underhand and frankly immoral activity that we've kind of touched on there. I mean, if I can move us on then to present day and coronavirus more specifically, I mean, it's really put the sector, if it ever was out of the spotlight, is certainly in it now. I mean, and biotech more specifically, some firms are up, over 700% since their mid-March lows. What's your take on this growth? I mean, is that something that can be maintained?
Well, the thing about something that's up 700%, it could be up 1400%, because if it didn't make sense yesterday, it's not going to necessarily make sense today. So that isn't necessarily going to be what guides us into getting into a short position. And what I find with a lot of these coronavirus related biotech plays is they tend to be very hard to borrow, because generally what you're seeing is a lot of institutional investors have decided to go short because they see that market movement. But then you also have retail investors who are now coming in, and other institutional investors who may not have biotech experience. And you have what people may call biotech tourists. And they may not understand exactly what's happening or what will happen or the data. They are relying heavily upon the narrative that the company itself is presenting, which is incredibly dangerous. So it's almost as though there's this wealth transfer between these biotech firms and retail investors, because a lot of the executives of these biotech firms are now also selling stock while retail investors are buying, and it's absolutely disgusting.
Yeah, completely. I wonder then, do you suspect any foul play on behalf of the biotech company specifically? I mean, could there be any credence given to this idea that firms are actually exaggerating their capabilities in regards to vaccine production, for example?
Well, you can always make data, clinical data, preclinical data, tell whatever story you want it to. And I think that is the problem we have here. going back to the idea that you have investors getting involved who are new to investing in biotechs, they won't necessarily understand how to parse the data itself. And that is what's going to cause the problem. And the executives of these companies are fully aware of that. And they aren't necessarily going to go out of their way to correct people's incorrect assumptions.
Yeah, of course. And no, that's really interesting. I mean, just to round off sort of the main body of the interview then, I wondered, obviously Wirecard's ongoing at the moment. I imagine that takes up an exorbitant amount of your time. I wonder whether there is any big short positions on your horizon, and obviously you can't give us specifics, but anything around those short positions that you can give our listeners.
It's one day at a time. I'll just say that right now we're at a point in time where the wealth disparity is at a level we haven't seen in modern times, and certainly not in my lifetime. So that is, I don't think that's sustainable. I hope it's not sustainable. And how that plays out for us as far as what we're shorting will be interesting to see.
Yeah, great. All right. Well, that's been really fascinating. So just to move us on to the end of the interview then, what we tend to do with all of our guests is ask them some quick fire questions. So simply a light-hearted way to end the interview. You can answer in as little as one sentence or even one word if you like. So the first one, I mean, in your opinion, what's the top mistake investors make?
I think we focus too much on the phrase, don't get emotional. I think investors need to realize that we're all human beings and emotions are a part of that experience. And emotions are what drive us to be better and to do better. So in reality, I think that what investors should realize and be aware of are their emotions, because that's the best way to make decisions taking those emotions into consideration. Yeah,
that's really interesting. So a second one then, where do you go for your investment or business insights? Any particular publishers that you like to read, for example?
I have no bias. I'm an information junkie, so I'll take it from anywhere.
Great. So a third one, your most memorable moment from your career to date?
Well, that I'll tell the story one day, but I can't tell it today.
Okay, great. I'm sure our listeners will be looking out for that. Number 4 then, a top tip for your younger self. Any advice that you'd give to your younger self?
Stop being so hard on yourself. I think we like to have really high expectations, especially, people who are very smart and very curious about the world. They expect so much of themselves, and that will put them in this really rigid box of what they do. And it's important to realize, again, we're all fallible. We're all imperfect. So just take it easy once in a while.
Yeah, sure. Certainly some great advice. So number 5 then, and the final question, what gets you mentally ready as part of your morning routine? Anything specific about your morning routine that helps you get set up for the day?
Walking my dog.
Nice. Good start to the day. All right, great. Well, you've been really generous with your time. So thank you very much, Fahmi. It was great to have you on the podcast.
Thank you. My pleasure.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest to you. Opto Updates is our short newsletter sent every day during a trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new podcasts, stock reports, or events from the Opto world. If you're interested, sign up using the link in the show notes. Until next time.